How's it going, investors? I'm Ari and welcome to the channel. Now, if you are brand new here, I want to start off by sharing that this channel is for the dividend or the value investor out there. So no surprise here that we're going to be breaking down high quality value investments that will pay dividends. And if you like what you see, you're certainly encouraged to do all your due diligence and then proceed to make investments into any or all the stocks that we talk about here. Now, I started this journey back in 2019 with a simple goal of hitting $100,000 in my Vanguard brokerage account while showing all of you through how easy investing really can be as long as we have a process. Now, I smashed through my $100,000 goal, but now, in the words of Jordan B.,
you know what? I'm not leaving. I'm not leaving. I'm not leaving.
In addition to breaking down stocks from video to video, I'm also going to be sharing tidbits of macro market insights because I do firmly believe that with a great understanding of this macro market environment, we as investors can certainly make better, wiser investment decisions. And that is ultimately now the goal here in walking this journey with all of you. So given all this recent market volatility, in today's video, we're going to break down what exactly has been going on. And then I'm going to leave you with 3 high quality, and I mean home run dividend investments. Now, with that all out of the way, I want to go ahead and jump right into it, but just before we do, tap on that thumbs up button for me. It greatly helps me out in growing this channel. And of course, if you haven't already subscribed, make your way over to doing so. Now, with all of that out of the way, let's dive right in. So let's get right to it, right to the brass taxes, and breaking down this past week, because what is going on in the market? Now, in my personal opinion, a lot of emotional investing. This isn't exactly a real term, but one that I've personally made up to define exactly what we've been experiencing. The Federal Reserve is in this blackout period. Given the next FOMC meeting is on November 2nd, they're going to be coming out and then announcing the next interest rate hike decision. Mark my words, interest rates will go up. Without any negative news, however, the market actually becomes very hopeful. The Federal Reserve and central banks around the world will become less aggressive with their rate hikes. But if one thing is to remain true, it's never fight the Fed. They have been telling us their plans for weeks and even months before they do it, and of course make that chess move of theirs. However, it's a very human thing to do, to only selectively listen to what you want to hear, not smart. Anyhow, where does this all leave us? Yes, emotionally investing, surfing the waves of all of these recent earnings reports. The big ones of this past week to note: Google, that reported a miss on earnings; Microsoft, who did hit earnings, except they did provide weaker guidance; Amazon, who also came in short of expectations; and Apple, who hit but missed on iPhone sales. All the news leaves investors just trying to gain more certainty on where exactly the market is, and with this certainty, we can put together some directions on where the market may be heading. But here's the thing. Earnings haven't been driving this market. It all comes down to 2 key metrics: inflation and unemployment data. Those are the market mandates, so November 2nd will certainly be a key date for all of us. Now, recently I was asked about a market's bottom and when we could expect to be in the clear. Well, I can't say for sure, though I wish I could. I will say this: the worst is yet to come, and I say that with confidence because of the inverted yield curve. This is the best indicator of a recession, which I think is going to hit pretty hard over the next 6 to 12 months. But don't panic. This is why we are in this together and on this journey, video by video, stock by stock, investment by investment. So let's get to some of these home run dividend stocks, the very first of which is a tech titan, but one I almost never really discuss because, well, I'm an Apple guy, but this is an opportunity that is just getting too good to pass up. And at the very least, I'm going to do my job over here in having you know about it. It's Microsoft, ticker symbol MSFT. Now, you're probably well aware of Microsoft's recent earnings report, and actually it reported better than expected, as I mentioned, but the stock still slid thereafter, given its weaker guidance, which already we spoke about is necessary for investor confidence. And of course, the rather negative guidance is all on top of a year worth of terrifying recession headlines, Fed rate hikes, supply chain disruptions, and just an overall reduction in consumer spending, which gives way for Microsoft to now be trading at a share price of $231.32 per share. That's a decline of over 30%, which is just bananas considering the fact that Microsoft is a dominant industry leader. I mean, guys, a $1.72 trillion market capitalization, not for nothing here, but we're talking about a bulletproof opportunity with a PE ratio coming in at just 24.9, which I would love to see come down. But as I always share, sometimes that premium is worth the price considering the fact that you're going to get financial security in an uncertain market with growth over the longer period of time. Now, Microsoft also just has a multitude of competitive advantages when it comes to products that are unmatched within the tech sector. I mean, we're talking about leaders in enterprise software and, of course, an Office suite that is just bar none. Not to mention, Microsoft has been on the come up when it comes to cloud infrastructure, video gaming, and hardware, while also moving to make some pretty serious acquisitions like LinkedIn, which I'm sure is why we're seeing plenty of hedge funds swooping in at these low valuations for Microsoft to score more shares of the company. You see $1.4 billion coming in from Bishop Rock Capital to another $1 billion coming in from Generation Investments, and the list goes on. Now, need more safety? How about a AAA credit rating that only 2 US companies have ever received, Microsoft being one of them? Now, get even more excited here because analysts are projecting upside. A matter of fact, 30% worth of upside coming in at a target share price around $302. And of course, as us dividend investors are all waiting for, their dividend is coming in just underneath 1% worth of a dividend yield at 0.99%. Now, from one industry leader to the next, I want to talk about America's #1 bank, at least according to assets. That's JP Morgan, ticker symbol JPM, which, given the interest rate environment over the last few years, it has suffered tremendously, and like all banks across the board, has yet to truly experience a rebound in share price, and therefore it's currently trading around $124 per share, which is over 20% worth of a decline considering at the onset of the year, JP Morgan was trading for around $156 per share. And while financial stocks are not necessarily the most common dividend investors' dream type of investment right now at this point in time, given their cyclical nature along with the potential to struggle even more should a recession actually hit us within the next few months, JP Morgan, with their $363 billion market capitalization, phenomenal leadership, and past experience navigating through some of the toughest crises like back in 2008, in which it didn't even need a bailout, gives me plenty of confidence to proceed with JP Morgan. Not to mention, Jamie Dimon himself is often referring to the bank's balance sheet as a fortress with enough capital to withstand any storm, while also making sure that the bank passes the Federal Reserve stress testing. But how about that PE ratio coming in at just 10.4, making JP Morgan a very attractive investment right now? Yet what excites me the most about investing into a bank like JP Morgan or some of these other industry leaders like Bank of America is the fact that they are among the biggest beneficiaries of higher interest rates, and of course with the Federal Reserve about to hike rates yet again that are likely to remain pretty high over a prolonged period of time until inflation is back down to around 2 to 3%. There's a lot of money to be made investing into banks, which is why we see hedge fund after hedge fund investing into JP Morgan. I mean, just looking at these investments, $510 million from Greenhaven Associates, or the Saudis coming in with a $433 million investment into the bank. And as for analyst expectations, a little over 11% worth of upside is expected, with a target share price coming in at $137.91 per share. Now, until JP Morgan reaches the heights of such a share price, there's a cool 3.27% dividend yield that we as dividend investors will be able to enjoy. And finally, let's go ahead and talk about semiconductors, because there's a lot of money to be made within this specific industry, at least in my opinion. Right now, given disrupted supply chains as well as trade tensions, some of these semiconductor investments have taken, just an absolute beating, one of which is Taiwan Semiconductor Manufacturing, ticker symbol TSM, which is actually one of the world's first semiconductor foundries, founded in 1987, and since then has become a dominant player within the chip game, amassing a $302 billion market capitalization. However, we can see it's down on the year by a whopping 52%, trading for only $60 per share. So what gives here? Semiconductors are essential to everyday lives. How could this one be hit so hard? when it comes to Taiwan semiconductor manufacturing, they of course have the Chinese breathing down their back. And not too long ago, if you recall reports of the Chinese doing their military drills just off the coast of Taiwan after Nancy Pelosi's visit, it certainly creates more of a riskier investment opportunity. But on the other hand, this particular chip investment has a monopoly on foundries, which is where chips are actually manufactured, and more of a monopoly on nanometers, those very small but high technology chips. Their PE ratios come in at 11.8, and I would say it's well worth adding to your watch list despite all the risk factors. Now at this time, we also see a lot of hedge funds pouring money into this particular semiconductor play. Now as for analysts, they too are favoring Taiwan semiconductor manufacturing with a price target coming in at $84.50 per share, which is over 38% worth of upside potential. But best yet, in the meantime, investors would receive a 2.42% dividend yield as they await the recovery. Now investors, that's it for today. From Microsoft to JP Morgan and Taiwan Semiconductors, the 3 dividend stocks that I'm strongly recommending that you do your own due diligence on and proceed to invest in if it makes sense for your portfolio. Now I would honestly love to know at this point if you've enjoyed today's video, if it's actually helped you on your investment journey, and of course you can do so by just tapping on that thumbs up button for me. Now if you have a thought or two about any or all of these investment opportunities, I'd love to know your thoughts, so drop them in the comments down below. Most importantly here is just joining me on this journey by simply subscribing to the channel. Do keep in mind I'm not a financial advisor, so of course I'm going to double down here and saying do your own due diligence prior to making any investment decisions. Guys, that is it for today. I will see you all in the next video.